Welcome back to Infinite Investors, the home for all new and non-investors. I'm Curtis, and today we're going to be talking about the topic of diversification. Look, I'm in the middle of my 2020 vision. I'm bang smack in the middle of it. I'm looking, I'm reviewing, I'm evaluating, I'm analyzing, I'm strategizing, and I'm just really trying to work out how much diversification plays a part in my 2020 vision and 2020 portfolio. You guys know that, my current portfolio, I had about 10 stocks at the beginning. I did pretty well, and then I sort of went off the rails a bit and went to about 25 stocks, and I've started to peel it back. And that was mainly because so many articles and so many different, experienced people in the industry were saying you need to diversify more, you need to diversify more. So now, looking into 2020, I'm starting to rethink and re-ask myself the question, and this led me to looking at the greats Warren Buffett and Ray Dalio, who have very, very, very differing opinions on diversification, incidentally. So I'm going to play some clips from both Warren Buffett and Ray Dalio, and then at the end I'm going to give my thoughts about diversification. So if you want to know more, please like, please comment, please subscribe. Help the channel get to 2,500 subscribers and the world of investing out to more people in a clear, simple and transparent manner. But first, let's go, Warren.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number one just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to, have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
You want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and yeah, it's.
It has no utility. But I mean, it will tell you how to do average. But I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult, and it's elaborate. And there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
When I look at the way you set up your portfolio, it's not as niche as that.
No, I'm big on diversification.
You're very big on diversification.
Like knowing how to diversify well is more important than almost anything. People don't understand this.
Is that an evergreen principle, you think?
Yes, that's an evergreen principle.
Interesting.
And the reason I'm saying that, the way it is, it's almost like a casino making its money. Okay. The way that you do it is you get an edge. So now when you have to make a bet, I've got to bet against the whole world. The world has a view on something is reflected in the price. So when I think something is attractive or unattractive, that means I have to bet against the whole world and whether that's right or not. That's difficult. I get it right, more often than I get it wrong, but I'm going to get it wrong sometimes. And so when you can take a lot of different bets, what you can do is, like the casino, you'll get your average that your bet would be, but you'll reduce your risk of one of those tables not being the table that's paying off. And so that margin, so I can reduce my risk without reducing my return by knowing how to diversify. And I'd say that's particularly important for the people who are listening, your investors. Because what they've got to
reduce risk without reducing return.
That's right.
That's the specialty.
That's right.
Elaborate a little bit more if you don't mind on that. So reducing risk without reducing the return, because a lot of times if I'm reducing the risk, it means my return's also going lower. But you're saying no, we're reducing it without even reducing the return.
Right.
I mean, that's a high-paying skill set to have.
It's the most important thing that you could start off doing. If you have a number of equally good likely bets, but they're uncorrelated, like the casino. One table is going to make me a margin like this, but take another table and it makes me a margin like this, but I might have volatility about those. Let me take all those investments that I think will make 10%, so that's my return, but they're uncorrelated with each other. That means I'll still get the 10. I don't lower my 10. But my diversification means I lower my risk. So I improve my return to risk ratio.
Is that an art that you can teach?
Oh, yeah. I wrote about it there's what I call a section in this book, The Holy Grail of Investing. It's 3 pages long. And it explains basically this important thing. Because when that epiphany happened to me and how I would do it, it changed everything. By being able to do that. Because
how old were you when you figured that out?
I can improve through diversification. I can improve my return to risk ratio by a factor of 5. So by diversifying, the return relative to the risk, I can keep my returns the same and reduce my risk to 1/5 if I know how to diversify well, and that's why I'm explaining it. It's not all that complicated. It's simply explained in the book. But in any case, that is the holy grail of investing.
So there you have it, 2 views from Ray Dalio and from Warren Buffett. And I, for one, if I had to lean towards any one of them, would be leaning towards more the Warren Buffett approach. And my reasons being is that I truly believe in the fundamentals of a company, and I truly believe that there are loads of good companies. However, I don't have the capacity to analyze loads of them, and I know that if I'm just buying 30 or 40 stocks, then I know that for every incremental stock that I add to my portfolio, I'm probably decreasing the amount of effort I do in terms of researching and making sure that that stock is actually a good pick. So I'd rather focus my energy maybe not on 3 stocks like he mentioned, but probably more towards the 10, 15 stock mark, where I feel that I can comfortably analyze that amount of stocks, to the greatest detail. One thing I will encourage you guys to think about is, what is your diversification strategy for 2020? Are you going to have a purely ETF strategy, which basically means that you don't need to, really worry about all of the underlying investments that might be part of that ETF, which for me, there's pros and cons to that approach anyway, at least from the perspective of not really understanding what holdings your ETF possesses. Or will you go with an approach where you're actually just going to pick 2, 3, 4 stocks that you think is really going to do well, and put all your eggs in that basket and not really worry about it? The thing about the Ray Dalio approach is that I'm not really confident in what he actually says, because one, I don't really like the whole betting scenario and the casino scenario that he's basically evaluated with. I believe that fundamentals of a company versus, I don't know, casino gambling is about as similar as a German Shepherd and an octopus. Like, the only similarity a German Shepherd and an octopus have is that they both breathe. Like, literally, that's it. And that's the same thing with the casino and with, investing in with fundamentals in mind. I think the only key factor that they both share is the simple factor that, it's both to do with money. However, when it actually comes down to, what happens, casino gambling is that you just don't know whether it's going to go red on black. But I think when a company is profitable, when a company doesn't have debt, when a company has rising consumers or rising sales, when a company is undervalued, when a company has, good ratio and good earnings and good insider trading and good technologies and good patents and whatever else that you're going to be looking at with that company, then I think that actually it's not really a bet, but it is more of a safe investment. So yeah, get in the comments, let me know your thoughts about your diversification strategy for 2020. Be interesting to hear what you guys have to say. And yeah, 2 greats, one that is, the 3rd richest man in the world, Warren Buffett, and one that's the 25th richest man in the world, Ray Dalio. Both obviously knew what they were doing, but maybe it's very different times and very different climates. Get in the comments, let me know how you feel. Please like, please comment, please subscribe, and I'll catch you next time with another investment video. Peace.